Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Dalipal Holdings Limited annual report. Dalipal Holdings Limited is a diversified investment holding company that provides a range of businesses and services globally. The company's primary focus is on supplying application equipment for energy development, particularly in the People's Republic of China and internationally. One of its key areas of expertise is the development, manufacture, and sale of various types of pipes, including oil and gas pipes, new energy pipes, and special steel pipes. These products cater to the growing demand for energy infrastructure development worldwide. In addition to pipe manufacturing, Dalipal Holdings Limited likely offers other related services and businesses that support its core operations. However, specific details about these additional services are not provided in the given summary. Dalipal Holdings Limited market capitalization of $10 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Dalipal Holdings Limited holds a significant advantage in their industry. Dalipal Holdings Limited trades at a higher price-to-book ratio of 6.52 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 71% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes, such as buybacks or dividends, rather than operational deterioration. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, key contributors include the expansion of the Middle East market, driven by local energy projects, as well as the surge in procurement of specialty pipes. The new energy segment has also seen significant growth, with a 25.3% increase in revenue from RMB 1,095,865 to RMB 1,395,399. Additionally, collaboration with customers on product development and intelligent manufacturing have contributed to revenue growth. Furthermore, market expansion in the domestic oil field market, driven by premium products, has also played a significant role. The sales of unique leading products and the upgrade of product mix have further boosted revenue. Moreover, technology innovation and commercialization mechanisms, digital empowerment systems, talent pipeline development, and resource integration capabilities have all contributed to growth. On the decline side, key contributors include the decrease in sales of new energy pipes and special seamless steel pipes, with a -1.8% drop. The oil and gas pipe segment revenue has also seen a slight decline of -0.6%. Furthermore, revenue from external customers in overseas regions has decreased by -37.1%, highlighting challenges in international markets. Overall, the drivers of revenue growth or decline are complex and influenced by various factors, including market expansion, product development, technology innovation, and changes in customer demand. Net income and profit margins. A shift in fortune initially, our company's net income took a hit, plummeting from RMB -77.1 million to RMB 13.7 million. However, this downward trend was short-lived, as the company managed to turn things around, with net income increasing by RMB 93.9 million. A closer look at profit margins reveals an encouraging story of improvement. The gross profit margin, a key indicator of a company's pricing power and operational efficiency, rose from 8% to 10.3%. This increase suggests that the company has successfully managed its costs and maintained or even increased its prices in the face of industry challenges. The net profit/loss margin also showed significant improvement, rising from -2.3% to 0.4%. While this is a notable turnaround, it's worth noting that there was no change mentioned on page 29, which may indicate some volatility in the company's performance during this period. The adjusted net profit/loss margin, another important metric, also showed an improvement from -1.7% to 0.7%. This suggests that the company has made progress in managing its expenses and optimizing its operations. While the exact reasons for the initial decline in net income are not explicitly stated, it's likely that industry-wide factors such as price wars and raw material price fluctuations, page 19, contributed to this downturn. Nevertheless, the company's ability to adapt and recover is a testament to its resilience and commitment to long-term success. The company's financial performance indicates a strong ability to generate cash from its core operations. The explicit statement on page 10 confirms that the company has achieved positive operating cash flow. This trend continues into 2025, as stated on page 35, where it is reported that the company generated positive operating cash flow during this period. The company's debt level has undergone significant changes over the past year. Specifically, non-current liabilities related to interest-bearing borrowings have increased by a substantial 98%. However, current liabilities associated with these borrowings have decreased by 28%, indicating a shift in the composition of the company's debt. In contrast, lease liabilities have seen a notable increase in non-current liabilities, rising by an astonishing 19%. This significant jump suggests that the company has taken on more long-term leasing commitments. Despite this, current lease liabilities have only increased by a relatively modest 2%. The interest expenses associated with these borrowings and leases also reveal some interesting trends. Interest expenses on borrowings alone decreased from RMB 79,645 in 2024 to RMB 62,227 in 2025, indicating a reduction in the company's borrowing costs. When lease liabilities are included, total interest expenses decreased even further, from RMB 86,858 in 2024 to RMB 67,073 in 2025. Overall, while the company's debt level has changed significantly, with notable increases in non-current liabilities related to both borrowings and leases, the associated interest expenses have actually decreased. This suggests that the company may be benefiting from more favorable borrowing terms or a shift towards longer-term leasing commitments. The performance of various segments and regions in the industry can be summarized as follows. Oil and gas pipes were a standout performer, with significant revenue and gross profit growth. In contrast, new energy pipes and special seamless steel pipes struggled, experiencing a decline in sales. Geographically, domestic sales remained relatively stable, increasing by only 0.8%. However, overseas sales saw a substantial surge, growing by an impressive 39% to account for a larger share of total sales. This indicates that the company's international operations are driving growth and expansion. Management is optimistic about the company's outlook, citing a significant increase in profit due to simultaneous growth in revenue and gross profit. This positive trend is attributed to the quality of services provided by employees, which are deemed crucial to the company's success. To mitigate risks, management has implemented measures such as hedging against exchange rate fluctuations through forward foreign exchange settlement. In terms of strategy, management emphasizes the importance of non-IFRS measures in providing a comprehensive understanding of the company's performance. However, they have decided not to recommend any dividend payment by the board, suggesting that the company is prioritizing growth over shareholder returns at this time. The company's financial history reveals a consistent practice of paying dividends to its shareholders. In 2024, the final dividend was approved and paid out at a rate of HK $0.04 per ordinary share. Although there is no mention of a dividend payment in 2025, it is clear that the company has made provisions for shareholder returns through this mechanism. Concerns about inventory buildup and supply chain disruption exist. There are valid concerns regarding inventory buildup in various industries. The accumulation of inventory has been a growing issue, with industry data showing an increase year-on-year. Furthermore, suggestions have been made to reduce work-in-process inventory, indicating that the problem is not only present but also acknowledged by experts. In addition to inventory buildup, there are also concerns about supply chain disruption. Shipping disruptions through strategic waterways, such as the Strait of Hormuz, pose a significant threat to global supply chains. This can lead to delays and increased costs for businesses, ultimately affecting their bottom line. That concludes the financial summary for Dalipal Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.